All right, good evening, everyone. Welcome to the Loan Officer Training Series with the Mortgage Calculator. Tonight, we're going to be talking about how to structure a HELOAN. Give us just a moment here to go live on all the different platforms. We will get into it here momentarily. We got the chat up on the screen there. Feel free to drop a comment there in the chat as you tune in. We appreciate those of you tuning in nice and early. All right, looks like we're live on all the different platforms, so we'll go ahead and get started. What we'll do is we'll take the chat off the screen for now, but go ahead and keep dropping comments in there, and you can drop any questions you have in the chat as we go through here today as well. Jose would be happy to answer any of your questions. All right, so welcome everyone. My name is Kyle Hershey. I'm the COO of the Mortgage Calculator, joined here by President Nick Hershey and our sales manager, Jose Gonzalez. We are a lender that specializes in non-QM loans, and what we do every Tuesday, Wednesday, and Thursday evening at 7 p.m. Eastern on this show is go through a new loan officer training topic. So tonight's topic is how to structure a HELOAN. Definitely something that's valuable for loan officers to know. So Jose, I'll let you go ahead and get right into the presentation here.
All right. How you guys doing? I actually sorry about that. I was didn't know if my audio was coming in. Um, Good to have you for tonight's training on HELOANs, how to structure a HELOAN. So let me go ahead. First, I got to share my screen here a minute. Had a little technical difficulty. So, what I want to get into tonight, really important on the differentiating the differences between a HELOAN, which is a home equity loan, and a HELOC, which is a home equity line of credit. We have had a lot of action on the home equity loan realm, right? So a lot of different options regarding guidelines. I would say that the activity in secondary there's a lot of momentum in DSCR loans, bank statement loans, I-10 loans, and definitely HE loans, fixed rate second mortgages. So let me not get ahead of myself and let me break it down for you in our presentation. So, what is a HE loan? I just touched on it right now. HE loan is a closed end fixed rate second mortgage. I was just stating that it is different from the HELOC, right? A HELOC is an open ended variable rate second mortgage, or a HELOC could actually be a first mortgage as well. So, big difference in being fixed rate versus variable rate. Uh, the HE loan is also available for primary residence, second home, and investors. HELOCs are also available for primary, second home, and investors, but they are much more restrictive in the income types. That's really where the investors uh, love the HE loan, because the HE loan is not only for full doc and bank statement, but also P&L, 1099, and DSCR. Now, mind you, there are some bank statement options for HELOCs, but they're very limited. They are not as so wide of offerings as we have with the HE loans for the bank statements. And that is really one of the points that we love here, because all of the DSCR loans that are out there where the investor may not want to refinance out of that nice 3 or 3.5% rate that they got a couple of years ago, and their property has substantially built up equity, and they would love to get a second mortgage on that property or properties so that they could acquire some additional investment properties. So you can see where I'm going with that. So, what are some transaction details for the HE loans? Well, our eligible borrowers are the usual that we've had lately, are U.S. citizens, permanent resident aliens, and non-permanent resident aliens. A non-permanent resident alien is a borrower that is legally residing and legally working in the United States. They don't have a green card, right, a permanent resident alien card, but they will either have some type of a visa that gives them work authorization, or they may have an employment authorization document, right, a work permit, quote unquote. Um, He loans are not applicable for foreign nationals. Foreign nationals are not eligible borrowers for he loans. Neither are ITIN borrowers. Eligible properties are 1 to 4 unit residential properties. Maximum LTVs are for primary residence 90%, for investment properties 70%. And the minimum credit score for the HE loans is 660 and up. So here's where we're going to start breaking it down. And because the structure to the HE loan, what really involves structuring the HE loan is what we're going to cover in the benefits of the HE loan and the blended rate, which we're going to cover, blended rate analysis, which we're going to cover in the next couple of slides. The guidelines are all going to be pretty basic, obviously. You can look at guidelines and see different scenarios that you may have regarding the income type, but it really boils down to understanding the HE loan benefits, right? So as I mentioned, now the DSCR borrower that might have a 3.5% interest rate doesn't want to refinance out of that just to get access to additional capital. Well, HE loan definitely provides a solution to that because, like I mentioned there, current rate environment may discourage borrowers refinancing out of low interest rate first mortgages. Second mortgage HE loans provide options that do not require refinancing out of a low rate first mortgage. You can combine an existing first mortgage with a new second mortgage, in this case, a HE loan, and this allows you to proportionately calculate the interest rate. That is known as the blended rate, right? Certain amount of a first mortgage at a certain interest rate plus a certain amount of a second mortgage, a HE loan, at a certain interest rate, and then you calculate the interest rate expense on each one, add that up, divide it by the total loan amount, and you have your blended rate. And I'm going to get into a little bit more detail on the formula in the coming slides. But, and then another, you have an additional good points are no prepayment penalty fee due to paying off an existing first mortgage. That DSCR loan probably had a 3-year prepay, maybe a 5-year prepay, maybe no prepay, but it probably had a prepay. And if the borrower says, not only am I going to get out of a 3.5% rate, but I'm going to pay a 2% prepayment penalty because I'm in year 2 of my 321, and that's going to be whatever, $200,000 times 2%, right? $4,000 additional eating into their equity. So a HE loan, obviously, and not having to pay off that first mortgage, there are additional savings there. And this is now probably could be considered splitting hairs a little bit here, but definitely when you are a loan consultant, you have to quantify all of these benefits. You can, actually write down the number that each amount is saving and present that to the borrower so they can actually see this is your total savings, keeping the low first mortgage, not having a prepayment penalty fee, staying in the existing amortization schedule that you have so that they are amortizing principal. Let's say they're in year 4 of a loan, right? They've already made more, let's say 40 payments go. You go to the amortization table and you're going to see what is the breakdown of principal and interest for that loan. It's probably going to be a lot more favorable, as in more principal than interest than day 1 on the loan, and certainly much more favorable than day 1 on a loan at twice the interest rate, right? You're going to be paying higher interest rate and amortizing less principal with each payment in the beginning. Whereas if you maintain your current loan, you're going to be paying more principal and less interest of a lower interest amount with each payment than if starting all over again from day one on at a higher interest rate. So definitely that's another amount you can definitely quantify. If they tell you where they are in their amortization table, what payment, for example, then you can go uh, download an amortization table for 30-year at that interest rate, and you can see exactly how much they're paying in interest and principal, and then how much they would be paying, see what the savings is, and add that to your whole tangible benefits there to the borrower from the HELOAN. And those are all real numbers that are going to make real difference to the borrower. So we've talked about the HELOAN benefits, and I mentioned about the blended rate and about the proportionate share of the first and the second. So in the image that you see there, you see exactly what happens, right? Usually the first mortgage is going to be larger than the second mortgage, right? And the blended rate is a weighted average of the interest rate on those two or more loans. Now, the blended rate essentially is the effective interest rate on the combined rate. It just sounds cooler and easier to visualize when you tell somebody the blended rate as opposed to when you're telling them the effective rate, which is the rate that the real rate that they're paying when combining those two loans. And I did mention second mortgage is usually smaller than the first mortgage, and this is what's so important about this whole concept now of adding a fixed rate HELOAN to a existing loan, because since the second mortgage is usually smaller than the first mortgage, the impact on the total payment is going to be less than a new higher interest rate first mortgage for the total loan amount. So, and that's pretty good when you present the borrower with the analysis and the tangible benefits. Now, I will state there are online blended rate calculators, right? So you can go like to blendedrate.com, for example, and just click in some numbers, and you're going to get the same calculations, right? But here, it's always good to know how the formula works so you can visualize the savings and better analyze it and explain it to your borrower. Simply going to an online calculator and putting in some numbers and getting an answer to the equation is not going to help you understand what's really going on unless you really know what's going on. So the blended rate calculator, like I mentioned, calculates the proportionate share of the interest rate for each loan. So how exactly do you do that? Well, first you have to determine what is the rate on the existing first loan, and we're going to call that rate 1. So that rate is 3.5% interest rate. Then we have to note what is the balance of that existing first mortgage. In this case, the balance is $350,000. Now, rate 2, that's going to be our fixed rate HELOAN product. Rate 2 is, let's say they're doing a DSCR type loan, and investment property, of course. So it's going to be a little bit higher rate. So that is at 11.75% rate. And let's say that balance on that balance 2 is $150,000. So how do you calculate the blended rate? Well, the blended rate equals rate 1, 3.5%, times balance 1, which is $350,000. Now that gives us $12,250. And then to that, you have 11.75, which is the rate for the HELOAN, multiplied times the balance of the HELOAN, which gives you your answer there. So then our blended rate is 5.975. You have 11.75 times 150 equals 17,625. And then when you add the two amounts, the 12,250 plus 17,625, that's your combined interest. Divide that by 500,000, your combined loan amount, gives you a blended rate of 5.975%, right? So 3.5, 11.75 equals 5.975%, which is, I can pretty much guarantee you, going to be lower than if the same borrower were to go and do the cash out refi on that same property using a new loan. You're going to have a higher interest rate. You're probably going to be at least high sixes or low sevens at least, right? And that's not taking it to the max LTV, and that's not for a low credit score borrower either. So definitely you can see. Oh, and again, when they're analyzing the benefit, remember the HELOAN is a fixed rate that's available, right, for primary second home investment. It's fixed rate. It's not a variable rate like the HELOC. So they're really going to be able to plan well whatever their next investment will be. So summing it all up here on our benefit analysis, right? This is some of the stuff that we would be presenting to our borrower to let them know this is really the way to go, right? So questions you would ask yourself, right? Does it save the borrower money? And this is what they're thinking. Does it save the borrower money compared to getting a new first mortgage? And is it better to add a second mortgage or refinance the first? So, the answer to that, definitely the borrower will definitely benefit from the new second mortgage, right? As the annual blended interest rate payment of 29,875, right? That's the interest payment on the first plus the interest payment on the HELOAN, is $13,875 lower than the payment for a new first mortgage for the complete loan amount, obviously at a higher interest rate than what they currently have. We're probably figuring like 7.5% on that. So you can see that our new first mortgage actually at 8.75. So we're talking taking this to the limit. 8.75% cash out refi DSCR. It could be a little bit lower now, but this is just for our example here. Gives an annual interest payment of $43,750, right? The blended mortgage interest payment is $29,875. That's where you can see the $13,875 lower payment, lower combined payment on the two. So definitely the way to go. Oh, and one additional benefit to note, not sure if I noted this on the benefit slide, was the closing costs, right? Now we weren't splitting hairs talking about the savings when you're amortizing more principal within the payment. Now we're talking really splitting hairs is the closing costs on a lower loan amount HELOAN are definitely going to be less than the closing costs to refinance that larger new first mortgage, right? Definitely something to consider there. So I really hope that you guys get the benefit here from being able to properly structure your HELOANs. Because again, like I was mentioning, the proper structure on the HELOAN begins with understanding the benefits that the HELOAN offers, understanding the differences between the HELOAN and the HELOC, and being able to break down through a thorough analysis like what we just did, the tangible benefits to the borrower so that they can you could basically empowering them so that then they can make an educated decision and decide if they want to refinance that larger first mortgage or if they want to just finance a new second mortgage HELOAN.
right, looks like we lost Kyle. I don't see any questions here. Going once. Nope, no questions. So we'll go ahead and wrap it up. We'll be back tomorrow on Thursday, 7 p.m. Eastern, for another episode of Loan Officer Training Series. So thanks, Jose. Thank you, everybody, for